The recent announcement that Unilever's food business was going to combine with McCormick's sent investors selling off both stocks. Traditionally, mergers in the food industry may look good on paper, but not always play out well when you're looking at the final numbers. However, this one may very well work out, and it's an interesting reason why. To explain it, we are joined by Emilie Feldman, who's professor of management here at the Wharton School. Emilie, great to talk to you again. And I guess let's start out by looking at why you think this may work out. And it's this concept of an RMT. Can you explain it?
Yeah, thanks, Dan. I'm happy to. Maybe a definition would be helpful because these are fairly rare. So, what is a reverse Morris trust? So, these are corporate transactions that combine a spinoff and a merger within the same transaction. So, you have a parent company that spins off one of its business units and immediately merges that unit with some other entity. So, in this case, we have Unilever spinning off its food business and immediately merging that with McCormick. So that's the RMT structure. And there's a whole bunch of tax stuff that's important, and we can talk about some of that if you like. But what's unique about these transactions is basically the discipline that this structure imposes on the companies that are involved. Because on the spinoff side, what we have is really a company that is parting ways with a unit that might not be a great fit within its portfolio. So thinking about getting rid of something that doesn't necessarily make sense.
Mhm.
But then the ability to combine that via a merger with some other company is really kind of the unique feature of this, because normally in a spinoff we would not see the benefit of synergies, for example. And there are various tax rules, like I mentioned, that kind of tie into this. But the fact that companies have to be very careful to meet these rules, right, and abide by them can impart some discipline into which partners are chosen
Right.
and how the ownership split is divided basically between the unit that's being spun off and the company that it's merging with.
Okay, so you talk about the tax component of this. Specifically is it within the rules that when you're doing an RMT actually ends up being a benefit from a tax perspective?
Yeah, definitely. What happens is that in general, corporate spinoffs can be tax-free transactions, and there are a set of rules that companies have to abide by for that to be the case. One of those rules is that no entity can acquire the unit that's being spun off within 2 years after the completion of the transaction. And
Right.
if you think about it, you can see why, because
Yeah.
basically you'd be kind of engineering a tax-free sale at that point, because if the spinoff is tax-free, but you're not taxing, someone is immediately acquiring it, then you basically engineered a tax-free sale. So what is clever about an RMT is that nobody's acquiring the entity that's being spun off. The entity that's being spun off is actually has to be, from a tax perspective, the majority owner in the merged company. So in other words, nobody bought the spun off unit, but it bought something else, right? And so
Right.
as a result, that's really the tax rule that is kind of the key feature of this. And so you end up with that merged company that has the spun off entity owning more than 50% of that combined entity, and the company that it merged with or acquired owning less than 50% of that entity. And so my thought on this, right, is that this really imparts a lot of discipline, right, into the choice of merger partner,
Right.
because it has to be the right size. It has to be the right fit. You can't have some unwieldy structure, right, where that ownership split is not going to be met exactly. And there has to be a willingness on the part of the target company to participate as well. So it's two sides.
So when you're talking about a company like Unilever, who obviously has so many different products, and they're looking to basically move on from their food business, and they match it up with a food company, this would seemingly be one of those instances when you're just looking at the entities involved that it would work, but that isn't always the case, correct?
Correct. Yeah. And I think so what kind of struck me about this is that no one thinks about it this way, but what is mayonnaise, right? Mayonnaise
Right.
is a spice, right? It's a
Right.
flavor,
That's
right?
true.
And
Yeah.
what is McCormick's identity? It's flavor, right? So I think that that idea of kind of fit, that idea of strategic logic, right? We're not merging with some company that has a whole bunch of different operations in this other area and we'll figure out what to do with it later, right? There's a really kind of close and tailored attention to kind of getting the right partner in this type of situation. And I think this McCormick transaction really exemplifies that perfectly.
Do you tend to see then RMTs occur more so in certain industries or within companies within certain industries rather than others?
Yeah, so let me contextualize it then, and then I'll answer your question. So, first of all, as you might imagine, given the conversation that we've had so far, RMTs are exceedingly rare.
Yeah,
So, in the study that I'm working on, which covers the period 1998 to 2023, these transactions started being used in 1998, by the way. There have been 50, right? 49 of them from that period, right? So that's very, very small if you think about the volume of M&A activity over that time period.
right.
So in general, these are rare. Now, to answer your question, yes, there is industry concentration, right? And so this is what's kind of unique about these deals, that we see them in contexts where synergies, especially from scale, are going to be valuable, right? So we see this a lot in IT services. We see this a lot in telecom and media. We see it a lot in radio stations, right? We see it a lot in oil and gas assets. And we see it a lot in fast moving consumer goods, CPG types of contexts as well.
Right.
Because precisely these ideas of kind of creating synergies, driving the cost structure down, and really getting those benefits of scale are the key advantage.
So then with these having been so rare over the last, I guess, 25 years or so that you have done this research and how they seemingly work well, is there a possibility, is there an avenue that we see other companies looking to make mergers look at this avenue as a potential way to make a deal work?
I hope so, right? I mean, I think that's if anything, right? I hope this transaction kind of shines a light on a phenomenon, on a deal type that is maybe not particularly well understood or even known by people, right?
Right.
And so I do hope that that's the case. That being said, right, I think that there's a very real challenge here, as I was sort of mentioning, of executing these deals properly, right? So you have to have that ownership split between the spun off business and the target company. The merger partner has to be willing to participate, and that's not always the case, right? If you think about it, you're basically going from being an independent publicly traded company as the target
Yeah.
to then being a minority player in that combined entity. That might not be appealing to every company, every public company that's out there. Especially so because the acquirer, so to speak, is just a division within some other company. So there might even be an ego thing going on there in terms of some of that some of that dynamic. So I think that those structural challenges are very real, right? Those execution challenges are very real in terms of getting those right merger partners to play. And so even though I hope it happens, right? I think that reality needs to be acknowledged.
So then what kind of impact then is it possibly that this type of a merger has on the larger M&A landscape as we move forward here?
Yeah, that's a good question. And I think that here the strategy piece becomes very important to emphasize, right? And so what are Unilever and McCormick trying to accomplish from a strategic perspective, right? This is, for me at least, all about economies of scale and cost savings,
Right.
right? Because basically we have McCormick with huge distribution channels, great assets. And the more flavor types of products that we can kind of pump into that, the more we can drive that cost structure down, right? And so bigger company, more scale, kind of driving those products out to consumers and shaping that cost structure is the key advantage. And so, what my research on this topic shows, we have kind of a neat framework in this paper that disaggregates the benefits from scale versus scope, right? So, scale being more of the same, scope being a greater diversity of products,
Right.
and then revenue enhancement versus cost reduction. And so what we find actually is that among the RMTs, the ones that are geared specifically towards cost reductions from economies of scale tend to exhibit the greatest shareholder returns, right? The highest shareholder returns. And so, even if we don't see a proliferation of RMTs, my hope is that this research sort of underscores the importance of the value driver of cost synergies and economies of scale as the factor that actually tends to create more value for companies that are engaging in M&A. And that's not specific to RMTs, that's general to mergers and acquisitions.
Emily, thanks for explaining it. Very interesting to go over this. And if for those of us that like mayonnaise every once in a while, it gives us a whole new landscape to think about where our mayonnaise is coming from.
Thanks, Deb.
Thank you. Emilie Feldman, who is a professor of management here at the Wharton School.